Hello, it's Thursday the 17th. I'm FxPlew and this is the market brief starting in the car park on my way to the train. Now, a rate cut from the Bank of England is all but nailed on today. Bailey wanted durable evidence of disinflation and yesterday's CPI data handed it to him on a plate. Inflation dropped to 3.2% in November, while unemployment has ticked up to a 5-year high. So, we've had no growth since the summer. Labour market is cooling pretty fast. Households are hoarding what little cash they can lay their hands on. And, of course, the housing market is sluggish at best at the moment. And that all rather reinforces all the warnings that we've heard from the MPC doves about the dangers of keeping rates too high for too long. No doubt the hawks will be squawking about the latent pressures of reigniting inflation. That is if we cut much more going forwards. But for now, a rate cut will be good news for Reeves. No doubt she hopes that monetary policy may spark some growth and distract from her fiscal policy failures. Of course, that kind of growth can't come quickly enough for her because there are rumours that Starmer's may be lining up Pat McFadden as a safe pair of hands in number 11. New year, new me is too basic for Starmer. Apparently his resolution might be new Chancellor for New Labour in the new year. Whammy. Over in the US, Christopher Waller, he's been on. He reckons that we are far from the neutral rate at the moment. He thinks there is between 50 and 100 basis points of rate cuts still to come. A pretty bold statement, firmly aligning himself with hashtag Team Trump, despite being out of the running to replace Powell. Remember, the current dot plot forecasts 50 basis points at best, and that's by the end of 2027. But he may have a point. Last week's rate cut was the third in a row, but jobs remains pretty stagnant. November's payroll growth was marginal and was more than offset by October's revision to include all the job losses from that federal purge. Unemployment is now at 4.6%, and it looks like the tariffs and the higher rate environment are still having a nibble and biting pretty hard. There is certainly a case to consider that rate cuts could kick some life into things, but of course at what inflationary cost? In the market, the dollar index clawed back some lost ground. That closed at 98.40 yesterday, and we kick off this morning around 133.65 against the dollar, 113.80 against the euro, and euro dollar is around 117.45 on the open. That's it from me, and if I dash, I might just make my train. Toodaloo.
If you do not have a clue, then just tweet through and ask FxPlew.